I'm Rebecca Corbin, CEO of Corbin Advisors. As was just mentioned, I'm thrilled to be here. A very heartfelt thank you to TÜYID, to Kerem, to Celine for just welcoming me and inviting me to speak today. I'm truly honored to be here. And next year I'll be speaking in Turkish, but this year I'm speaking in English. So we're going to talk about global trends in investor relations. And the way that I think about this is really around outperformance. I'll get into what Corbin does, but we are a leader in equity valuation strategies and have a track record with re-rating public companies. And we've done a tremendous amount of research from the institutional investor and sell-side analyst universe. The firm was founded in 2007. I've spent 25 years in capital markets. 18 years ago, this past November, I started my own company. And fast forward to today, we're over 70 associates. We draw our talent from the buy side, from the sell side, investment banking, corporate development, and investor relations. We work with over 135 clients globally on any given year, and that continues to grow. And we're very keen on results and very keen on our NPS score, if you're familiar with Net Promoter Score. Our Net Promoter Score is 9.2 out of a 10. We have our own value impact improvement score, and that's 9.2 out of a 10. We really focus our energy on research and advisory. So we spend a lot of time conducting bespoke investor research, our Voice of Investor perception studies, which we've trademarked Voice of Investor, valuation analyses, communication gap analyses, really getting into the technical communication and sentiment from shareholders and how you're communicating with your stakeholders, both in terms of shareholders and prospects. And then we do a tremendous amount of IR advisory, earnings advisory. We work on special situations, M&A, activist defense, and we're really geared toward helping our clients become best-in-class companies, to build durable franchises through understanding what is best-in-class. And we have spent 18 years conducting over 27,000 surveys and interviews with the financial community, portfolio managers, analysts, sell-side analysts around the world. Very large organizations, Abu Dhabi, McKinsey, Fidelity, Norges, Capital Research, Wellington. If they have large assets under management, we have likely interviewed them as part of our Voice of Investor perception studies for our clients. Our clients range from pre-IPO all the way up to USD 700 billion in market cap. So we work with very large organizations. And we spend our time understanding this particular stakeholder group, which is the shareholder. And we want to understand what motivates them. And we bring that insight and research to our clients to help them understand what this very important stakeholder is thinking and what their expectations are and what their needs are, to be able to have confidence and trust in that company, to be able to then invest with that company. Our research is one of the largest databases in the world, Corbin Analytics, and I'm going to present research today from our Corbin Analytics database, a very small sampling of the research that we produce on a weekly basis. We are a leader in thought leadership for our industry. I've spent a lot of time in our own society, NERI, and also in Canada at CIRI. Again, I'm thrilled to be here today. So first I want to set the stage. According to the buy side, institutional investors. I'm going to talk about institutional investors, shareholders, the buy side. They're all synonyms. They're all the same. 89% say that investor relations influences valuation. And I've spent the last 18 years of my career, and really 25, engaging with boards and executive leaders to help them understand and appreciate how critically important investor relations is. And it's not just the IR function. It's the board, it's leadership, it's everybody who is communicating with the financial community and, quite frankly, executing at the company, because we want to deliver outperformance. And when we drill down into how much actually does investor relations influence share price? Well, the buy side says on average it's 38%. If it's good investor relations, you can actually have on average a premium of 38%, or with suboptimal or poor IR, it can be a pressure or a weight on average of about 41%, pressuring your stock's valuation over time. So we don't want to have that pressure on our stock. We want to control the controllable. And investor relations is about controlling the controllable and making sure that we are instilling confidence and communicating effectively with the financial community. So when we look at the best-in-class archetype, and we have the very unique position of working with best-in-class companies, how do we know they're best-in-class? Well, the only way that we can determine that is by voice of investor research, of going out to their shareholders and their prospects and their sell-side analysts that cover them, and asking them, what do you think about the company's strategy? What are the strengths and weaknesses? What do you think about the leadership team? What are their strengths and weaknesses? What do you think about investor relations? And what are their strengths and weaknesses? And I'm simplifying the work that we do, but we get tremendous insights. And then, because of our massive database that is over 27,000 interviews and over 1,000 companies globally, we benchmark. And we have superior benchmarking to rate a company relative to its peers, to its sector, to its market cap size, and the best-in-class group of companies that we have comprised through our research. The best-in-class group, and I'm going to show some data throughout this, are companies that are the highest rated in Corbin Analytics by their shareholders and relevant to the 1,000 other companies in there. So these companies also have the highest ratings, the highest level of buy-in with strategy, the highest respect for the leadership team. Their investor relations functions and professionals are absolutely best in class. They also trade at a premium to their sector and index on a 3, 5, 7, 10, 15-year plus basis. These companies outperform in the equity markets, and we essentially have the diagnostic of what that profile of an outperformer is. I'm going to share some of that research. First, on the left-hand side, you have to have financial profile and outperformance on the metrics that are most important. So we want to grow above market. We don't necessarily have to be so far above market. If the market is decelerating by 18% and we're only decelerating by 10%, guess what? We're outperforming. If the market is growing by 7% and we're growing by 9%, guess what? We're outperforming in the eyes of investors. So we have to have financial profile and performance. And they are focused on revenue growth. They're focused on profitability. In fact, when we survey and ask institutional investors, what do you weight more, growth or profit? They almost always say profit. So they want both. They want to have their cake and eat it too, as the saying goes. But they are focused on profitable growth. Number one metric across our entire database of the metric that institutional investors use to evaluate public companies. Free cash flow. Free cash flow. They run a DCF. And essentially what they're doing is they're looking at the discounted cash flow and they are assessing the risk and they're discounting. They're discounting. So when we think about that discount and valuation, what that actually is are investors and analysts saying, I don't trust, there's not enough communication, they don't have a track record of delivering, they don't have guidance, they are a serial misser, all of the things that they're adding up in terms of the risk. So companies that execute on the financials outperform. A culture of sustainability emphasis, and I'm not talking about sustainability in the environmental sense. I'm talking about through cycle performance. So when the cycle is in a period of deceleration, which we've been in, companies know which levers to pull. And traditionally, companies that outperform in a down cycle are cost cutting. They are managing expenses. They are being very, very prudent with how they're running the company. They're pulling back on investments and they're weighting it. They're not knee-jerking, but they're looking at the growth and they're looking at the profit and they're sustaining margin. And then when we come back out, they're usually ahead of the curve with regard to investment. I will tell you that we track the S&P 500 on a quarterly basis. We're very ingrained. We follow every sector. We understand what's happening in the macro at a very, very big level. And for the first time 2 quarters ago, the S&P 500 moved from buying back their stock, deploying a lot of capital to buying back their stock, to investing in CapEx. That is a big deal. First time we've had it in years that we're seeing a big investment. So I'm not calling an inflection on the macro, but I'm saying that there are signs that companies are starting to think about the growth, and investors are thinking about growth too. And then also, on what you have to be an outperformer is the recognition of Corbin Critical 5, which I'll get into. These are the 5 critical factors that we have identified through the 27,000 interviews that we've done and surveys that we do with institutional investors as the most important factors that they look at when making an investment decision. On the other side, that's the if you build it. So we have to deliver. We have to execute, and we have to deliver on what we say we're going to do. And that's really important to be realistic about what we're going to be doing versus aspirational and heroic, because you can really anger investors if you say something and you don't get to that place. So under promise, over deliver. I always joke, if I had 2 tattoos, which I don't have any tattoos, but if I had 2, it would be under promise and over deliver, and don't own the macro. Don't own the macro. On the other side of the house, okay, is communication. So even if you're excellent at delivering on expectations, you have to communicate. We need to think of the product that we're selling to that customer, we heard about it earlier, as equity. We're selling a product as a public company, and that product is equity. And we need to make sure, and it's a very competitive market. Institutional investors essentially can invest in any company they want. They're very, very rarely where they're tied down to a small mandate. Most investors say, I can invest anywhere. So you're competing not against your sector peers or your business peers. You're competing with other companies. Generally, market cap is the focus, but all companies around the world. So how do you differentiate your investment opportunity? It's through communication. And it's understanding the voice of investor and what their needs are to be able to target that communication most effectively, to be able to herd the global institutional investor landscape, which is very challenging to do, but outperformers do it exceptionally well. If you think about your employee base or even your customers, how much energy goes into communication, effective communication, getting everybody on the same page to move. Investors are the same way. High transparency and disclosure. We don't just want to disclose for disclosure's sake. We want to responsibly disclose information that is important to investors that helps them understand the story. If you just disclose a lot of data, and this is what we saw with ESG, where companies were getting asked a lot of questions and they were just talking about everything. No, it's about materiality. What is material to the company? And that may be different than what's material to your peers. So you have to really think about the disclosure. And a lot of companies never go back and say, what have we been disclosing? Maybe we should change our disclosure and tighten our disclosure. And if you do that, you have to communicate to the street why you're doing it. Never make a change in financial disclosure without communicating it. When we change financials for our clients, we generally communicate it for 2 to 3 quarters across all communications that we were making this change and why, so that the market absorbs it. And then we have to have active customer cultivation. I talked about IR is sales. IR is technical sales. And if you've ever spent any time in sales, it is hard. You have to cold call. You have to pitch. You may get turned down for 8 years, but then all of a sudden, one day, the stars align, the price target aligns, and you have a new shareholder, and they come in big. Persistence, organization, we're going to talk about that. But it is technical sales, and it's about operational excellence. So I would not be the mom who has breakfast at any time in the morning. I'm the mom who's like, breakfast is at 8 o'clock in the morning, right? When we're talking about operational excellence and IR. Got to be structured. The Corbin Critical 5. One day I will write a book, and it will be on this, because this is the heart of our research and advisory. These are the 5 focus areas of institutional investors and what we advise our clients on. Number 1 is leadership. Okay? They are very focused on leadership. What is the hallmark of best-in-class companies? Credibility. That is the number 1 hallmark according to the buy side. Credibility. Number 2 is long-term strategy. Do you know how many times I'm researching a company and there is no concept of strategy in their communications? I can't find where their corporate strategy is. It's not in their presentations. They're not mentioning it on their earnings calls. Institutional investors want to understand what your strategy is. 3 to 4 pillars, how you're driving it, what is it? Do I agree with it? Is the company executing against it? Can I see progress being made? Okay, so it's really important to include strategy in your investor communication. Number 3 is track record. It relates to strategy. You build a track record based on guidance set and hitting your guidance targets, both in terms of the short-term, long-term targets. By the way, the vast majority of institutional investors, 70%, prefer 3-year targets if you're setting long-term targets to any other time frame. And also in the long term, saying you're going to execute on a strategy and then communicating. The best opportunity to communicate in this way are at capital markets days, when you have the entire universe of the buy side and sell side tuning in, and you can walk them through for 4 hours an immersion on the company. Here's where we were, here's where we are, here's where we're going. Number 4 is competitive advantage. And within this, the top tied for number 1, high barriers to entry and operational excellence. Companies that outperformed are exceptional at operational excellence, from the manufacturing floor, product, pharmaceutical process of launching, all the way up to anything done at the top of the house. They are operationally excellent. They have codified operating models. Other technology is one, scale is another, and management actually can be a competitive advantage if you have a very, very strong dynamic team. And finally is capital deployment. At the end of the day, institutional investors are capital deployers. So they want to understand how you are deploying your capital, and there are a finite number of uses, right? Reinvestment or organic growth, buybacks, dividends, debt paydown, acquisitions. Okay, and so they need to have an understanding of what your capital deployment strategy is, what you're prioritizing, and your history against that. And this is what we evaluate companies on, and companies that outperform are exceptional at these, and in an unaided question, these will come up as strengths of those companies without being prompted. When we think about outperformers, 100% of institutional investors say that management is the top. And for these companies, management is the most frequently cited strength. Market position, capital allocation, and I want to highlight margin profile, then growth. Margin, then growth. The secret to outperforming is profitable growth. That's why a lot of growth companies who are overly focused on growth trade at a discount. And they're like, why can't we're growing so much. No, they want the profitable growth, they want the free cash flow and the capital deployment. When we look at an institutional investor and we look at the management, hallmarks of management, credibility, strategic vision, execution, strategy articulation, the ability to manage expectations, deploy capital, their track record in M&A. By the way, if you can have a respected track record on M&A, if the buy side thinks that you can do M&A well, that is the secret sauce of outperformance. It's the kind of added benefit of what we talked about. You can see that the outperformers, very elite group, are very highly rated compared to the average. And generally speaking, the compounder formula is double-digit earnings growth. That's what institutional investors are focused on. So now I'm going to, with that stage set, I really want to talk about some of the things that we focus our time on in terms of best-in-class communication. It's a stock picker's market out there, okay? You can have a tremendous amount of headwind from the macro, so does everybody else. Don't use it as an excuse. How are you communicating through any type of situation, any type of dynamic, that you are controlling the controllable and driving your destiny forward? That is what investors want to understand. So let's get into earnings. We think about earnings through process excellence, value-added materials, and expectations management. Earnings is very different country to country, okay? So we, obviously, you probably guessed, I'm from the United States of America. We are one of the most mature markets in terms of capital markets and investor relations. And so we set the standard for communication, okay? Our US president is obviously talking about rolling back some of our earnings communication from 4 times a year to 2 times a year. It's not going to fly. Investors don't want that. Why? Because it limits transparency. And it also, companies don't want it because it's going to force them to not have the ability to speak with their institutional investors, given our regulation fair disclosure clause, which means that we have to have material public information out there to be able to talk about it. When we think about process excellence, 91% of IROs that we survey around the world adhere to a quiet period. That means that from the time that their quarter ends until their earnings call, they are, or their publication of their information, they are not speaking with institutional investors. Best-in-class companies will take calls, as long as they're not on earnings. If they're on the company strategy or they're ramping up on an investment, they will take that. 62% pre-record calls. I want to highlight that having an earnings call is best practice. If you do not have an earnings call, you are essentially putting yourself into a box that is less transparent than many other companies. So if you're not doing an earnings call right now, and you're just doing the minimum reporting that's required by the regulatory body, not enough. Not enough to capture mind share. Investors need a steady flow of information, and when you report something on black and white paper and make somebody else interpret that, you're losing control of your own narrative. You're losing control of your own narrative. So earnings calls are very important. Press releases are very important. Interestingly, over half of companies that we survey globally say that their forecasting, their ability to guide the company, is suboptimal. It's mixed. Just over a third say we're very strong at this. And over 50% also say the reason why institutional investors are challenged to get into my company is it's a complicated story. Over half of companies think their story is complicated. And this is true. Companies are complicated. You have to step back, and you have to be able to cut through the noise and give them the 30,000-foot view. I always say, talk to investors as if they're a precocious 12-year-old. Okay? Because you guys are sector experts. And if you work in multiple sectors, you might be experts in each one of those sectors. But that portfolio manager is following many different sectors, and they're not an expert in your company. And they need to understand the fundamentals first to be able to get them into your restaurant to then go deeper into the discussion. So when we talk about process excellence, manage the sell side from quarter end to quarter close. The sell side is putting consensus out. We don't want consensus to get away from us. And the buy side has to actually use, and generally uses, consensus as the benchmark, and they have to make a case as to why the company is going to do better than consensus. So if consensus is artificially high because you're not managing it down, you're hurting yourself, and you're going to miss consensus, and we all know what happens when we miss consensus. You want to have a process around materials. Like operational excellence in investor relations is critically important. We start the calendar a week before the quarter closes, and we run up to earnings. And I'd like to say that all companies do that. They do not. We would not be in business if that was the case. They're very lax around process. Process is critically important to investor relations. And you want to just drive rigor on the materials. You want to hold management accountable. Management, as we all know, they're the ones that blow up the process. So if you're a CEO or a CFO, remember that we need to have process, and you need to get on that train so that we can be successful. We don't want to be going into an earnings period, hair on fire, and not able to be confident and prepared. There's value-added materials. The value-added materials for institutional investors are the press release. The press release is critically important. And there are very strong standard best practices, which I'm happy to talk to anybody who wants to understand what are best practices around any of these communications. I'm not going to go through them today. But there is a very specific structure that you need to have if you're using that to encourage long-term investors. Your prepared remarks on earnings calls, whether you say them, which is best practice, or if you publish them, not as much. Your Q&A performance. I work as a coach to executives of big and small companies because a lot of segment leaders don't understand how to engage with institutional investors. A lot of CEOs and CFOs are not street-facing. They understand their company, they don't understand what the investor is going for. And so managing that and training on that is critically important. In the US, we have shifted. If you are a CFO without street-facing experience, you are at a disadvantage. So more and more companies are looking for investor relations as a capability because it is a skill set in the executive function. Your earnings presentation, okay, if you don't have an earnings presentation, you're leaving money on the table. It is critically important to institutional investors. 88% say it is a meaningful presentation, communication that companies publish. So very important to have that along with your prepared remarks, your press release. When we think about managing expectations, we have statistically correlated transparency with credibility, meaning that companies that receive higher scores on transparency also receive higher scores on management credibility, okay? Transparency is not disclosure. Transparency is context. Transparency is color. Transparency is helping them understand. And it was mentioned earlier, don't think for 1 second investors understand your company. They don't. And you have new investors coming into your stock all the time listening to what you're saying. So you have to really treat it as a first-time, low-level communication. And then obviously in your one-on-ones you can go deeper. But you have to have the bigger, broader communication to bring investors in and not build up the walls through technical communication, through acronyms. That gets very challenging for institutional investors. As we've been discussing, the best-in-class group outperforms the universe on expectations management. It is truly the X factor. And what is expectations management? It's alignment with business strategy in the context of the opportunity in the macro. It's frequent and consistent, clear communication, broad-based messaging. It's strong financial and operational acumen, command of the numbers. Okay, command of the numbers, and those numbers are consistent. And it's not introducing new numbers. It's sticking to the script of what you communicated in public forums. It's transparency and being reality-based around guidance and candor. And it's that say-do execution. We said it, we did it, we're telling you that we did it, and now we're going to tell you what we're going to do again. We heard that this morning. When we look at guidance, and we've done exceptional studies over 18 years on guidance, and every time we do a random sampling of 100 companies, we look at 50 that don't give guidance and 50 that do, and we look at their performance. And every single time, companies that give formal financial guidance outperform on a 3, 5, 7, 10, 15-year basis. Because it helps the street understand the company. Leaving it up to their own devices or leaving it up to the sell side to analyze you, they don't know your company. They don't understand all of the ins and outs of your company, so providing financial guidance, critically important. The most important metrics based on institutional investors: revenue, EPS, EBITDA, margins, CapEx, free cash flow, ROIC, and OpEx. These are the most important, and not to give all of them. Usually we advise our clients to give 2, no more than 4 measures. And I'm saying this with responsibility. If you cannot forecast your business, then don't forecast your business publicly, but really build that muscle internally. And if you're not providing financial guidance yet, you should start to do that each quarter. Test yourself. What would we have communicated to the financial community if we were providing guidance, and build that muscle so that you can start to do that, because it is a competitive differentiation. Capital Markets Days. We as a firm have executed over 350 Capital Markets Days. Guys, I just want to let you know this screen is out. And it is a re-rating event if you do it well. It can also serve to destroy credibility if you don't do it well. And there are a lot of landmines when you're talking about Capital Markets Days. But institutional investors say it is one of the leading elements, communication elements, that companies can do that they're looking at for information. If you have a Capital Markets Day presentation on your website, that is where institutional investors are going to first. Why should you host a Capital Markets Day? Well, first of all, it crystallizes the equity narrative. And it really is a forcing function internally to be able to get on the same page with all of your executives, with your investor relations, and really think through the content that we're going to communicate to the street. It's an immersion on your company. Number 2 is it provides access to management. We talked about how important leadership is. Well, they get to see and hear from leaders directly, not on an earnings call, not a sell-side conference, but for 3.5 to 4 hours, with opportunity for Q&A, with opportunity for a social element, to be able to truly understand who is this team, how do they work together, are they cohesive, do they understand their company, are they all speaking from the same place, and investors will go up to each executive and they'll ask them the same question, and they'll see if executives are aligned on the messaging. Number 3 is it creates a durable set of materials for institutional investors. 125 slides of content, depending on the size of the company, but generally that's on average. It is a repository to ramp up on a company, and it's very important in terms of their investment decisions. If you are announcing long-term targets, it's the opportunity to either reset those, to communicate that you've achieved them, to then set new targets. And again, this lends itself to building a track record of this is what we said we were going to do, and this is what we did. And if you think about that product analogy, right, you're selling a product, and if you think about Apple and their iPhones, they come out with an iPhone every couple of years and they generate a lot, billions of dollars of sales. An Investor Day is our opportunity to innovate on our product. It's the only time that we can cut through the noise, that we have our stage that is company sponsored. It's not sponsored by a sell-side analyst. It's not a 25-minute presentation or a 25-minute earnings call. It's a very in-depth immersion on the company and allows us to innovate on what the investment thesis is. All too often, companies talk about their products to investors. What they miss communicating is their own product, which is why you should invest in us. Why you should invest in us. 89% of investors say that a well-executed CMD is a valuable use of their time. They could spend weeks and months learning about a company that they can get in one day. 88% say you should host a CMD no matter what is going on with the company or the macro. These are not big reveal events. Okay, this is not about sizzle, it's about education. Let me educate you on who we are, what we do, where we are, where we're going. And then 84% say that these types of events can actually drive a stock re-rating. What's a re-rating? A re-rating is when you're trading in line with your index or sector peers, and all of a sudden you have an event and you trade over a long period of time at a different, higher level. That's a re-rating, and that's what we're going for with our investor days over the long term. Every 2 years, irrespective of market cap, small, mid, large, institutional investors say you should have these events every 2 years. We say don't go more than 3 years without having an event. It's very important to get out in front of the financial community. 80% are open to attending company events at the headquarters. So that's important too. If you have something to showcase, very important. And the number one draw by far is the leadership team. So it should never be just the CEO and CFO, because they have access to the CEO and CFO all the time, hopefully. They want to have access to the next level of leadership, to field experts, to be able to understand the company at a different level. Content is critical. The leading content on an investor day or capital markets day, what does it start with? Long-term strategy. And this is in order from the buy side. Capital allocation strategy, what your priorities are, long-term targets, your financial overview, drill downs into margin and organic initiatives, your M&A strategy, segment deep dives, your product pipeline, your M&A scorecard if you do it. We just completed our Investor Day survey with institutional investors this year. We do this every 2 years. And this right side of the slide was mind-blowing to me, who's been doing this for a very long time. 91% of investors say they always review the presentation after the event. 91%. Only 36% actually go back to the transcript. And only 6% of investors actually go to the webcast, underscoring how critically important the presentation is. The presentation must stand on its own. We work with a lot of big tech CEOs. They have been trained. I don't want to have a lot of words on my slide. I want the audience focused on me. Couple bullets, I'm going to talk. Well, they're not going back to that script. They're going to the presentation. And we've all looked at presentations where you flip through it and you're like, I don't even understand any of these slides. I don't know what they do. There's nothing here in strategy. It's a lot of charts and graphs. Don't do that. 73% of institutional investors say content rich. I want lead-ins. I want content. I want takeaways. We don't want complex, complicated slides, but we do want content rich slides. When we surveyed corporates on capital markets days globally, this is what they said. 100% said, plan early, 12 months in advance. We start planning a CMD. Where are we going to have it? Lock down management calendars, get the agenda going. The big lift comes about 4 to 6 months in advance of that event. That's really where we're working. You want to establish clear ownership. Who is driving the bus? Who is running the process? And you want to have a process. You want to engage advisors if you cannot execute it on your own. And over 65% say, go out to the shareholders, go out to the investor, understand what they know, what they don't know, what their concerns are, what we need to clarify so that we can target our message through a perception study in advance of the event, not after the event. Now let's talk about best-in-class IR. Most valued IR qualities by the buy side. Again, we survey 27,000 interviews, every perception study that we do. Number one is accessibility. I need to make sure that if I have a question, I can get in touch with the IR leader. The best-in-class IR leaders that I've worked with, honestly, no matter who they are, I get an email within 3 seconds. They respond. I've received your email. I've got it. I'll get back to you. It's just responsiveness, and accessibility. Their company knowledge, they're a resource. They understand the company, they understand the segments, they have the depth of knowledge about everything about the company. It's a pretty big job, investor relations. And I'm out there, making sure that boards and executives understand how dynamic this role is. The ability to answer questions or go into the company and find somebody who can answer the questions. That's critically important. Transparency and disclosure, which we talked about, response time, and then the ability that they are providing access to management. Very important. When we look at high-performing investor relations teams, they have the main ones, right? Responsiveness, they are much more focused on responsiveness, IR accessibility, company industry knowledge. But these last three are really around next-level communication. Next-level communication, their investor presentation content, the earnings call content. This is a lot of work that goes into building presentations and keeping them updated and maintaining them. It's our demand generator. That's what, I just showed a slide, 91% always go back to the presentation for CMD. They also go to the investor presentation. If you do not have a standalone investor presentation on your website, and I'm not talking about an earnings presentation or a sell-side conference presentation, I'm talking about a comprehensive, standalone, here's what we do, here's who we are, strategy, financials, you're missing out. You are essentially telling the investor, I don't want to provide information, and if an investor has two companies that are fundamentally equal in terms of the investment opportunity, and one is highly complex and lacks information flow, and the other one has information flow, strong IR, they're investing in that company. So it is absolutely a hurdle. You know this, you're in the field. But I do run into companies that don't have investor presentations, or they have investor presentations that are a year old, or they're very skinny and they don't get into any type of the information that we talked about. By the way, that's also a red flag for activist investors. Activist investors actually are using investor communication now as a screen. And I have had one of the largest activist investors say to me, if a company doesn't have an investor day, that's a red flag. So that's how they're thinking about it. When we think about the investor presentation, very similar to the CMD, many of the same things goes into what you're communicating at this smaller type of investor presentation. And I'll round out, AI is obviously a trend. We track mentions of a lot of different things, including layoffs and AI. 17 times increase in companies mentioning AI on their earnings calls. What we have been advising our clients is you need to have an AI strategy. Many AI strategies that we look at and we review and analyze are very tactical, and they're focused on efficiency. You need to go 30,000-foot view. We need to be thinking about AI strategy in the context of both productivity and efficiency, as well as growth. How is AI enabling revenue growth? And we need to be able to communicate efficiently and effectively with investors. If you're not getting questions on this right now, you will be. It was one of the hottest topics on earnings calls this past quarter for executives and in the follow-up calls. So I have been advising our clients to put it down on paper. Get it down on paper. If you haven't done your board report yet on AI, put it down on paper. When did you start? How are you thinking about it? The use cases, categorizing, and you want to roll it up to a high-level platform, and then you want to go down into what case studies can we be communicating to our investors every quarter, different case studies that demonstrate how this is being run through the company that is quantified. And in investor relations, AI is really about scale. But like we said earlier, AI and HI, I call it human intelligence. Human intelligence, okay? So first of all, why is AI important in IR? It's a very manual job at this point. So IROs are looking at it from an efficiency, speed, productivity, the ideation, drafting capabilities, large data processing, and the leading use cases are the investor communication analysis. You can feed a lot of your investor scripts into AI and determine if there are gaps. Our clients are doing that with us. Sentiment analysis, competitive intelligence, right? Feeding all of those transcripts into AI, good prompts to understand what our competition is doing. Data analysis, so it is going to be revolutionary in IR, and we are, in the US, I think we're actually at the bleeding edge. There are a lot of us that are focused on championing this, technologies, et cetera. Happy to talk about AI and IR, introduce you to some folks who are industry leading in our investor relations industry. But this is where we can really drive capacity in IR, right? To be able to focus more on the strategic, proactive efforts, which a lot of times IROs aren't able to be proactive and anticipatory because they have to be reactive. This should allow us to free up some time. So in closing, the big so what, IR influences valuation. You know this. Leverage your role to drive greater credibility and trust, right? I hope you walk out of here and say, I'm going to go review our investor communications and websites to see what we're doing well and on where we can improve, because that's our window in. Capital markets days are one of the most powerful levers that companies have at their disposal to influence sentiment, to educate investors, to really provide that perspective of, hey, we're differentiated, this is why you should invest in us. It cuts through the noise, and you're competing with every other company out there, like I mentioned. And IR's role is broader and more strategic than ever. Excellence is defined by proactive communication, transparency, engagement, strategic content, and efficiency. So with that, I want to thank you. I've saved us 2 minutes and 55 seconds giving it back, but thank you again.